absolutely right that infra investments have gone up exponentially in last few years, reaching around $200 billion or so. What is it standing right now? But if you look at actually the need, this is what the market estimates say. The need is around $400 billion or so. 10% of the GDP. So we are still, after all this boost, sitting at half of what is really required in the country. So that's the opportunity. $200 billion extra needed in the country compared to what we are doing as of now. So that means we'll have to obviously change a lot of financing models that we were operating under up till now, and that's the opportunity we are looking at it from the MDB side, and that's what also something that I wanted to point out and bring it to everyone's notice, that the exponential rise has happened indeed, but what needs to happen is unimaginable as an opportunity throughout the world. So what will it take? That's the demand side of the equation. On the supply side, there has been a big change in the country. We have more than $1 trillion sitting with insurance and pension funds, and this $1 trillion is going up by 10-12% every year. So it means $100 billion are getting added to the kitty every year, which can go into sectors like infrastructure and other critical areas. So we have the money, just that the two pieces are not, meeting each other, and there is this disintermediation angle that needs to be fixed so that the money that exists in the country can be channeled into critical sectors like infrastructure. And that's the strategy I think we need at the macro level, at the big picture level, which I think we need to talk about. So how do we make that happen? So from MDB side, yes, we have been funding infrastructure in India and many other countries also, but this will always be a drop in the ocean when it is compared to the needs in India. So it will never be enough. So we need to look at how we are leveraging this story, how we are mobilizing private capital through our money. So in the bank, we are now started looking at PCM. That is, for every dollar that we are putting on the table, how much is the private capital mobilization that is happening? So how much is the leverage that is happening? Which means internally, we also need to relook at our models, but also the kind of projects we do, the kind of financial structures that are available in the market. So no longer, I would say, the plain vanilla financing would work for India. You would have to look for guarantees, you would have to look for credit enhancements, you would have to look for risk-sharing facilities in the market where there is risk-sharing and there is scalability in the projects. So I think from that perspective, there are a lot of good examples available throughout the world. A lot of countries are now looking at guarantees as an instrument to mobilize private capital. And I think this budget announcement this year that NAFID will be starting a credit enhancement platform in India bodes very well for the market. And I think that is what is needed. Bond market utilization still remains small in India compared to other countries. The bond market size, the corporate bond market size is still stuck at around 16% of GDP. Whereas our peer countries are, much ahead in 30-40% range. So if you have to mobilize insurance funds, pension funds, you have to mobilize the bond markets, and for that you need risk-sharing instruments and credit enhancements.